Question 1. A Canadian life insurance policyholder has a universal life policy that has accumulated significant cash value. If the policyholder makes a withdrawal from the cash value, which of the following is true regarding its taxation in Canada? A. The entire withdrawal is immediately subject to tax as income. B. Only the portion of the withdrawal exceeding the adjusted cost basis, ACB, is taxable. C. The withdrawal is entirely tax-exempt as it is from a life insurance policy. D. It is considered a loan and is only taxable if not repaid. Answer: B. Only the portion of the withdrawal exceeding the adjusted cost basis, ACB, is taxable. In Canada, withdrawals from a universal life policy's cash value are generally taxable only on the portion that exceeds the policy's adjusted cost basis, ACB. The ACB essentially represents the cumulative net premiums paid into the policy, less any previous withdrawals, ensuring that only the investment gains are subject to tax. For example, if you paid $10,000 in premiums and your ACB is $8,000, a $10,000 withdrawal would result in $2,000 being taxable income. Remember, the death benefit paid to beneficiaries is typically tax-free, but living benefits like withdrawals have tax implications based on the ACB. Question 2. Which of the following statements best describes the primary purpose of Assuris in Canada? A. To regulate the conduct of insurance agents and brokers across Canada. B. To act as the federal prudential regulator of insurance companies in Canada. C. To protect Canadian policyholders in the event their life insurance company fails. D. To resolve disputes between policyholders and insurance companies. Answer: C. To protect Canadian policyholders in the event their life insurance company fails. Assuris is a not-for-profit organization whose primary purpose is to protect Canadian policyholders by minimizing the loss of benefits in the unlikely event that their life insurance company fails. It provides protection up to a specified maximum for various types of policies, including life insurance, health insurance, and annuities. This acts as a safety net, ensuring that policyholders do not lose all their coverage or invested value if an insurer becomes insolvent. Think of Assuris as Canada's version of a deposit insurance corporation, but for life insurance. Question 3. An individual living in Ontario wants to purchase a life insurance policy. Which provincial regulatory body would primarily oversee the licensing of the agent and the sales practices in this transaction? A. Office of the Superintendent of Financial Institutions, OSFI. B. Financial Services Regulatory Authority of Ontario, FSRA. C. Canadian Life and Health Insurance Association, CLHAA. D. Financial Transactions and Reports Analysis Centre of Canada, FINTRAC. Answer: B. Financial Services Regulatory Authority of Ontario, FSRA. In Canada, the licensing of insurance agents, brokers, and the oversight of market conduct and sales practices primarily fall under provincial jurisdiction. The Financial Services Regulatory Authority of Ontario, FSRA, is the specific regulatory body responsible for these functions within Ontario. While OSFI regulates the solvency of federally incorporated insurers, and CLHIA is a trade association, it is the provincial regulator like FSRA that ensures agents are properly licensed and conduct business ethically within their province. Each province has its own equivalent regulatory authority for licensing and market conduct. Question 4. A client holds a limited pay whole life insurance policy in Canada. What does limited pay specifically refer to in this context? A. The policy provides coverage for a limited number of years. B. The policyholder pays premiums for a specific, predetermined period, after which no further premiums are required. C. The death benefit amount decreases over time. D. The cash value accumulation is capped at a certain amount. Answer: B. The policyholder pays premiums for a specific, predetermined period, after which no further premiums are required. A limited pay, whole life policy means that premiums are paid for a specific, finite period, such as 10 years, 20 years, or until age 65, after which the policy is considered paid up and no further premiums are required, yet the coverage remains in force for the lifetime of the insured. This contrasts with traditional whole life where premiums are typically paid for the entire life of the insured. This option is appealing to those who wish to complete their premium payments during their working years. Question 5. A policyholder with a universal life policy in Canada has designated her son as the revocable beneficiary. If the policyholder decides to change the beneficiary to her daughter, what action is required? A. She must obtain her son's written consent to change the beneficiary. B. She can change the beneficiary without her son's consent by notifying the insurer. C. She must wait for the policy's annual anniversary to make the change. D. She must surrender the current policy and purchase a new one with the desired beneficiary. Answer: B. She can change the beneficiary without her son's consent by notifying the insurer. When a beneficiary is designated as revocable, the policyholder retains the right to change the beneficiary at any time without needing the consent of the current beneficiary. The policyholder simply needs to inform the insurance company in writing of the desired change. This flexibility is a key characteristic of revocable designations, contrasting sharply with an irrevocable designation, where consent from the named beneficiary would be required for any change. Question 6. Under Canadian tax law, what is the tax treatment of the death benefit paid to a beneficiary from a personally owned life insurance policy? A. It is always considered taxable income to the beneficiary. B. It is generally received by the beneficiary completely tax-free. C. It is taxable only if the policy's cash value exceeded the adjusted cost basis, ACB. D. It is considered a capital gain and taxed accordingly. Answer: B. It is generally received by the beneficiary completely tax-free. A significant advantage of life insurance in Canada is that the death benefit paid to a named beneficiary from a personally owned policy is generally received completely tax-free. This tax-exempt status of the death benefit is a core benefit, providing financial security to the beneficiaries without any immediate tax burden. This is why life insurance is often used for estate planning and wealth transfer, as it ensures the intended funds pass directly and efficiently to loved ones. Question 7. A Canadian client is considering purchasing a Term 20 life insurance policy. What does Term 20 primarily indicate about the policy? A. The policy will pay a death benefit only if the insured dies after 20 years. B. The premiums are guaranteed for 20 years, and the coverage lasts for 20 years. C. The policy can be renewed for up to 20 terms. D. The policy's cash value will mature in 20 years. Answer: B. The premiums are guaranteed for 20 years, and the coverage lasts for 20 years. A Term 20 policy signifies that the insurance coverage is for a fixed term of 20 years, and the premiums are level and guaranteed for that entire 20-year period. At the end of the 20-year term, the policy generally expires, or the policyholder may have the option to renew it, typically at a significantly higher premium, or convert it to a permanent policy. This structure makes it suitable for specific, temporary financial needs, such as covering a 20-year mortgage. Question 8. What is the main purpose of the Medical Information Bureau, MIB, in the Canadian life insurance underwriting process? A. To conduct medical examinations of applicants. B. To act as a central repository for applicants' health information reported by member insurance companies. C. To provide medical advice to underwriters. D. To approve or deny insurance applications based on medical records. Answer: B. To act as a central repository for applicants' health information reported by member insurance companies. The Medical Information Bureau, MIB, is a non-profit association that operates a confidential database of health information reported by member insurance companies during the underwriting process. Its main purpose is to help detect and deter fraud and misrepresentation by applicants, ensuring that insurers receive accurate and consistent information. For instance, if an applicant fails to disclose a serious medical condition to one insurer, the MIB record might reveal this to another insurer. It does not make underwriting decisions, but rather acts as an alert system, prompting further investigation. Question 9. In Canada, what is the primary role of the Office of the Superintendent of Financial Institutions, OSFI, concerning insurance companies? A. To regulate the sales practices of insurance agents and brokers. B. To ensure the solvency and financial soundness of federally regulated insurance companies. C. To investigate consumer complaints against insurance companies. D. To set the premium rates for all insurance products in Canada. Answer: B. To ensure the solvency and financial soundness of federally regulated insurance companies. The Office of the Superintendent of Financial Institutions, OSFI, is the federal regulator responsible for supervising and regulating all federally incorporated or registered banks, insurance companies, and other financial institutions in Canada. Its primary role is to ensure these institutions remain financially sound and stable, protecting depositors and policyholders. This focus on prudential regulation is distinct from provincial bodies that regulate market conduct and licensing. Question 10. A policyholder has an exempt life insurance policy in Canada. What does this exempt status primarily mean for the policy's growth? A. The policy's death benefit is exempt from taxation. B. The cash value growth within the policy accumulates tax-free, up to certain limits. C. Premiums paid into the policy are tax-deductible. D. The policy is exempt from any provincial regulatory oversight. Answer: B. The cash value growth within the policy accumulates tax-free, up to certain limits. In Canada, an exempt life insurance policy means that the investment income and capital gains earned within the policy's cash value component can accumulate on a tax-deferred basis, and potentially tax-free if held until death. The exempt status refers specifically to the internal accumulation of earnings, allowing them to grow without being immediately taxed, as long as the policy adheres to certain CRA-defined actuarial tests. This provides a significant tax advantage for long-term savings within a life insurance contract. Question 11. Which of the following statements is true regarding a participating whole life insurance policy in Canada? A. It typically offers lower premiums than a non-participating policy due to shared profits. B. Policyholders receive dividends, which are guaranteed payments based on the insurer's profits. C. Policyholders may receive dividends, which are not guaranteed and are treated as a return of premium for tax purposes. D. The cash value grows only when the policyholder makes additional deposits. Answer: C. Policyholders may receive dividends, which are not guaranteed and are treated as a return of premium for tax purposes. A participating whole life policy allows policyholders to participate in the insurer's divisible surplus, meaning they may receive dividends. These dividends are not guaranteed and are typically declared annually based on the insurer's financial performance. For tax purposes in Canada, these dividends are generally treated as a return of premium, which means they are not considered taxable income when received by the policyholder. This distinguishes them from non-participating policies, which do not pay dividends. Question 12. A critical illness rider is added to a life insurance policy in Canada. What is the primary benefit of this rider? A. It provides a lump sum payment to the insured upon diagnosis of a covered critical illness. B. It waives future life insurance premiums if the insured becomes critically ill. C. It allows the insured to access a portion of the death benefit while alive for any reason. D. It pays for long-term care expenses if the insured becomes critically ill. Answer: A. It provides a lump sum payment to the insured upon diagnosis of a covered critical illness. A critical illness rider, or standalone critical illness insurance, is designed to provide a lump sum, tax-free payment to the insured upon diagnosis of a specified critical illness, such as cancer, heart attack, or stroke, provided they survive a waiting period. This payment can be used for any purpose, such as medical treatment, recovery costs, or maintaining lifestyle. This benefit is distinct from the death benefit and provides financial support during a challenging health crisis. Question 13. What is the primary distinction between a renewable and a convertible feature on a Canadian term life insurance policy? A. Renewable allows conversion to permanent, convertible allows renewal without requalification. B. Renewable allows the policy to be continued at the end of the term without a medical exam, convertible allows conversion to a permanent policy without a medical exam. C. Renewable guarantees a lower premium at renewal, convertible guarantees a higher death benefit. D. Renewable applies to the death benefit, convertible applies to the cash value. Answer: B. Renewable allows the policy to be continued at the end of the term without a medical exam, convertible allows conversion to a permanent policy without a medical exam. A renewable feature on a term policy gives the policyholder the right to extend the coverage for another term, regardless of changes in health, though at an increased premium reflecting the insured's attained age. A convertible feature gives the policyholder the right to convert the term policy into a permanent policy, like whole life or universal life, without providing evidence of insurability. Both options are valuable because they remove the risk of being uninsurable at a later date. Question 14. An individual applies for a life insurance policy and fails to disclose a significant pre-existing medical condition. If the insurer discovers this within the incontestability period, what action can the insurer typically take in Canada? A. The insurer must pay the death benefit but can sue the estate for misrepresentation. B. The insurer can deny the claim and void the policy due to material misrepresentation. C. The insurer can only adjust the death benefit amount downwards. D. The insurer must pay the death benefit as long as premiums were paid. Answer: B. The insurer can deny the claim and void the policy due to material misrepresentation. The incontestability period, typically 2 years in Canada, allows the insurer to investigate and potentially void a policy if there was a material misrepresentation or concealment by the applicant during the application process. If the undisclosed medical condition was material, i.e., it would have affected the insurer's decision to issue the policy or the premium charged, the insurer can deny the claim and void the policy. After this period, the policy generally becomes incontestable, except in cases of fraud. Question 15. What is the main difference between an individual life insurance policy and a group life insurance policy in Canada? A. Group policies are always more expensive than individual policies. B. Individual policies require an application and medical underwriting for each person. Group policies are typically issued to an employer and cover multiple individuals under one contract, often with minimal or no medical underwriting. C. Individual policies do not have cash value, group policies always have cash value. D. Group policies are regulated federally, while individual policies are regulated provincially. Answer: B. Individual policies require an application and medical underwriting for each person. Group policies are typically issued to an employer and cover multiple individuals under one contract, often with minimal or no medical underwriting. The fundamental difference lies in how coverage is provided and underwritten. Individual life insurance policies are contracts between an insurer and one person, requiring an application and often medical underwriting for that specific individual. Group life insurance, conversely, is a single contract, master policy, issued to an employer or association, covering multiple eligible individuals, e.g., employees, within that group, often without individual medical underwriting, relying instead on the large number of participants to spread risk. Question 16. A policyholder in Canada borrows money from the cash value of their universal life policy. How is this policy loan typically treated for tax purposes? A. It is considered taxable income at the time of the loan. B. It is generally not considered taxable income at the time of the loan, as it is a debt. C. It is taxable only if the policyholder defaults on repayment. D. It is treated as a partial surrender and is taxable if it exceeds the ACB. Answer: B. It is generally not considered taxable income at the time of the loan, as it is a debt. A policy loan from the cash value of a universal life or whole life policy is typically treated as a debt against the policy, not as taxable income, at the time the loan is taken. The policyholder is borrowing their own money, or rather, borrowing from the insurer using the cash value as collateral, and interest is usually charged on the loan. If the loan is not repaid, the outstanding amount plus interest will be deducted from the death benefit upon the insured's death. Question 17. Which clause in a Canadian life insurance policy prevents the insurer from disputing the validity of the contract after a specified period, typically 2 years, except in cases of fraud? A. Misrepresentation clause. B. Free look clause. C. Reinstatement clause. D. Incontestability clause. Answer: D. Incontestability clause. The Incontestability Clause is a vital provision in Canadian life insurance policies that states that after the policy has been in force for a specified period, commonly 2 years, the insurer cannot dispute the validity of the contract or deny a claim based on misstatements or omissions in the original application, unless those misstatements were fraudulent. This clause provides a sense of security to policyholders, ensuring that their beneficiaries will receive the death benefit without endless scrutiny once the contestability period passes. Question 18. An agent is helping a client apply for a life insurance policy in Canada. Which federal legislation primarily governs the protection of the client's personal information collected during this process? A. The Insurance Companies Act. B. The Personal Information Protection and Electronic Documents Act, PIPEDA. C. The Canadian Anti-Spam Legislation, CASL. D. The Income Tax Act. Answer: B. The Personal Information Protection and Electronic Documents Act, PIPEDA. The Personal Information Protection and Electronic Documents Act, PIPEDA, is Canada's federal private sector privacy law that governs how private sector organizations, including insurance companies, collect, use, and disclose personal information in the course of commercial activities. This legislation ensures that client-sensitive health and financial information is handled securely and ethically by insurance companies and agents. While other acts are relevant to insurance, PIPEDA specifically addresses privacy. Question 19. If a life insurance policyholder in Canada allows their policy to lapse due to non-payment of premiums, but then wishes to reinstate it, what must they typically do? A. Pay only the current outstanding premium. B. Provide evidence of insurability and pay all overdue premiums plus interest. C. Purchase a new policy without any re-underwriting. D. Wait for a mandatory 90-day waiting period before reapplying. Answer: B. Provide evidence of insurability and pay all overdue premiums plus interest. To reinstate a lapsed life insurance policy in Canada, the policyholder typically must provide evidence of insurability, e.g., a new medical questionnaire or exam, to demonstrate that they are still an acceptable risk, and pay all overdue premiums plus any accrued interest. Reinstatement is usually allowed within a specific period, such as 2 or 3 years from the lapse date, and reactivates the original policy, often preserving its original issue age and cash values. This is generally more advantageous than applying for a brand new policy. Question 20. What is the primary role of the Canadian Life and Health Insurance Association, CLHA? A. To regulate the solvency of Canadian life insurance companies. B. To act as a trade association that represents the interests of its member insurance companies and develops industry guidelines. C. To provide compensation to policyholders of insolvent life insurance companies. D. To license life insurance agents and brokers across Canada. Answer: B. To act as a trade association that represents the interests of its member insurance companies and develops industry guidelines. The Canadian Life and Health Insurance Association, CLHIA, is a voluntary trade association that represents the collective interests of its member life and health insurance companies in Canada. It develops industry-wide guidelines and best practices, advocates on behalf of the industry to governments, and provides information to consumers. While it plays an influential role, it is not a regulatory body. Its guidelines complement, rather than replace, statutory regulations. Question 21. Which of the following best defines insurable interest in the context of a Canadian life insurance policy? A. The potential for the policy to generate investment returns. B. The financial or emotional loss that would be suffered if the insured person died. C. The amount of premium an individual is willing to pay for coverage. D. The legal right to assign the policy to another party. Answer: B. The financial or emotional loss that would be suffered if the insured person died. Insurable interest means that the policy owner would suffer a financial or emotional loss if the insured person died. This concept is crucial at the time the policy is purchased because it prevents speculative purchasing of life insurance on individuals with whom one has no genuine connection. For example, a spouse has an insurable interest in their partner, and a business has an insurable interest in a key employee, due to the potential financial impact of their death. Question 22. A Canadian client is advised to purchase a life insurance policy that is assignable. What does this feature allow the policy owner to do? A. Change the beneficiary at any time without their consent. B. Transfer ownership rights of the policy to another party, typically as collateral for a loan. C. Receive a cash payment from the policy without surrendering it. D. Renew the policy at the end of its term without requalification. Answer: B. Transfer ownership rights of the policy to another party, typically as collateral for a loan. An assignable life insurance policy means that the policy owner can transfer their ownership rights, or a portion of those rights, to another party, often as collateral for a loan. This is called a collateral assignment, where the policy's death benefit acts as security for a debt. For example, a business owner might assign their life insurance policy to a bank as security for a business loan. Question 23. A Canadian life insurance policy includes an accidental death benefit (ADB) rider. When would this rider typically pay out? A. If the insured dies from any cause. B. If the insured dies as a direct result of an accident, often within a specified time frame. C. If the insured becomes totally and permanently disabled due to an accident. D. If the insured dies while committing an illegal act. Answer: B. If the insured dies as a direct result of an accident, often within a specified time frame. The accidental death benefit (ADB) rider is an optional addition to a life insurance policy that pays an additional lump sum, often double the face amount, if the insured's death occurs as a direct result of an accident, and typically within a certain number of days, e.g., 90 or 180 days, of the accident. It does not cover deaths from natural causes or specified exclusions like suicide or dangerous activities. This rider provides extra protection for unexpected accidental fatalities. Question 24. Which of the following statements about the free look period in Canadian life insurance policies is accurate? A. It is a period during which the policyholder can make a claim without any waiting period. B. It is a specified time, usually 10 days, during which the policyholder can review the policy and return it for a full refund of premiums. C. It is the time frame for the insurer to contest the policy after issuance. D. It refers to the period during which the policy's cash value is not accessible. Answer: B. It is a specified time, usually 10 days, during which the policyholder can review the policy and return it for a full refund of premiums. The free look period, also known as the right to examine period, is a consumer protection feature mandated by provincial regulations in Canada. It grants the policyholder a specified number of days, commonly 10 days, but can vary, from the date of policy delivery to review the policy terms and conditions. If they are not satisfied for any reason, they can return the policy to the insurer for a full refund of all premiums paid, without penalty. This allows buyers to carefully consider their purchase after receiving the physical policy. Question 25. A life insurance policy in Canada contains a suicide clause. What is the typical effect of this clause if the insured commits suicide within a specified period after policy issuance? A. The policy will pay the full death benefit regardless of when suicide occurs. B. The policy will pay the full death benefit only if suicide occurs after 1 year. C. The insurer will typically refund the premiums paid, but no death benefit will be paid. D. The insurer will pay a reduced death benefit to the beneficiaries. Answer: C. The insurer will typically refund the premiums paid, but no death benefit will be paid. The suicide clause is a standard provision in Canadian life insurance policies, typically stating that if the insured commits suicide within a specified period, commonly 2 years, from the policy's issue date, the insurer's liability is limited to a refund of the premiums paid, and no death benefit will be paid to the beneficiaries. If suicide occurs after this period, the full death benefit would typically be paid. This clause is designed to prevent individuals from purchasing life insurance with the intent to commit suicide.